Welcome to This Explainer. Today, we're hosting a true heavyweight financial matchup. It's the Roth versus the traditional IRA. These are two of the most incredible wealth-building tools at your disposal, but they operate very differently. And honestly, choosing the wrong one for your specific situation could literally cost you tens of thousands of dollars over your lifetime. We're going to break this battle down in the simplest way possible. All right, to start things off, I want you to just picture a scenario for a second. Imagine you decide to tuck away a very specific, manageable amount, exactly $500 every single month, dedicated purely to your retirement. You set it, you forget it, and you just let time do its thing. Now, fast forward 30 years. Thanks to the absolute magic of compound growth, that $500 a month didn't just sit there gathering dust. It's exploded into over $500,000. Crazy, right? It feels amazing. You've basically won the retirement game. Section 1, the tax timing dilemma, or as I like to call it, the IRS wants their share. But hold on a second, just as you're getting ready to pop the champagne and celebrate that massive pile of money, a very familiar guest knocks on the door. Yep, the government. And they are here to say, hey, congrats on the success, but we're going to need our cut. Okay, let's dive into this. The ultimate question you have to answer is this. Would you rather pay taxes on that money today or decades from now when you finally withdraw it? That single question of timing is exactly what separates a Roth IRA from a traditional IRA. And trust me, guessing wrong on this choice can cost you dearly in the long run. Let's look at the contenders so you can pick the actual winner for your wallet. Moving on to Section 2, traditional tax breaks today. So, a traditional IRA is a retirement account where your contributions might be tax deductible right now. Depending on your current income level, and whether you've got a retirement plan at work, you get to deduct that cash from your taxable income this year. Basically, you pay less to the IRS this coming April. Sounds like a killer deal, right? I mean, who doesn't want immediate savings? But the IRS is patient, very patient. They're totally cool giving you a break right now because they know they're going to collect later. Here's exactly how that life cycle plays out. Step 1, you put in that pre-tax money. Step 2, your investments grow tax-deferred. That just means you aren't paying any taxes while the money is sitting there growing in the account. But step 3 is the catch. Once you hit retirement and actually start pulling that money out to live your life, every single dollar you take out is generally taxed as ordinary income. Which brings us to Section 3, Roth, tax-free tomorrow. Now in the other corner, we've got the Roth IRA. And the Roth works in almost the exact opposite way. Instead of tax breaks today, this is all about tax-free tomorrows. A Roth IRA is funded entirely with after-tax money. Since you're putting in cash that the government has already taxed, you get absolutely zero tax deduction today. Actually, scratch that. If you're just looking at your current tax return, this initially sounds like a much worse deal than the traditional IRA. Why on earth would you willingly give up a tax break today? Now, what's really interesting about this slide is the sheer magic of what happens next. You make those after-tax contributions today, sure, but then your investments grow completely tax-free. And as long as you follow the rules, every single qualified withdrawal in retirement is 100% tax-free. Think about that. Imagine watching your investment double, triple, maybe even 10x over the decades. And when you finally go to pull out that $500,000 we talked about earlier, you owe exactly 0 pennies in taxes on it. Not one, no way the IRS gets a cut of that growth. It's a massive reason why financial experts are absolutely obsessed with the Roth. Section 4, the matchup. Let's move to and see how this builds with Sarah versus Mike. Financial theories are great, but let's ground this with real-life case studies. And this brilliantly illustrates why your own situation matters so much. Meet Sarah and Mike. Sarah's 25, she's making $60K a year, and she's just starting out. Naturally, she expects her salary and her tax bracket to go way up over her career. So if Sarah uses a Roth IRA, she pays taxes right now at her current relatively low tax rate. Fast forward to retirement, that huge grown pile of money, she takes it all out tax-free. Perfect fit for her. Now look at Mike. Mike is 58. He's earning peak lifetime income right now and retiring soon. Once he retires, his income will drop, so he expects to be in a much lower tax bracket then. For Mike, a traditional IRA makes way more sense. He desperately needs that upfront tax deduction today, while his taxes are painfully high, and he'll gladly pay the taxes later when his rate is way lower. Beyond just the math of tax rates, there's another massive difference between these two contenders: flexibility. A traditional IRA eventually forces you to take the money out through mandatory withdrawals. You literally have to start pulling cash out even if you don't need it to live on, simply because the government eventually wants their tax money.
But a Roth IRA? There are absolutely no mandatory withdrawals during the owner's lifetime. That means your money can just sit there, compounding and growing tax-free for as long as you want to leave it.
Section 5. How to choose your IRA strategy. So how do you actually determine your winning strategy based on your own expectations? Don't fall for the trap of short-term thinking. So the crucial point is, retirement planning is about decades, not this year's tax refund. The biggest, most common mistake people make is picking an account just because it saves them a few bucks today. Saving a couple $100s on this year's tax return could literally cost you tens of thousands in taxes later if you pick the wrong account. You gotta think long-term.
It really boils down to a pretty simple matrix. If you're young, just starting out, or you firmly believe your tax rate will be higher in retirement than it is today, the Roth IRA is usually going to be your best bet. You're locking in today's lower rates. But on the flip side, if you're closer to retirement, currently making peak income, and expect your taxable income to drop significantly after you stop working, the traditional IRA will probably save you more money overall. Oh, and quick pro tip, a lot of savvy investors actually use both. Having both buckets gives you ultimate tax flexibility when you finally retire.
Ultimately, there is no one-size-fits-all champion here. The smartest investors get that building wealth isn't just about growing the pie, it's equally about strategizing so you can reduce your future taxes and keep more of that pie. Understanding this one fundamental decision on timing can make your retirement infinitely more comfortable. So, I'll leave you with this question. Knowing what you know now about your own trajectory, which side are you taking? Are you Team Roth or Team Traditional? Let me know your winning team down in the comments because your future self is definitely depending on the choice you make today.